All right, guys, welcome back to another episode of Sky's the Limit Podcast. I'm your host, Mike Doherty, and today we have a guest, awesome guest, Wayne Courreges. He is the founder and principal managing director at CRE Partners, which currently has over 60 million in assets based in Texas, and he invests in Louisiana and Alabama as well. Wayne, he primarily focuses on acquiring apartment complexes and developing RV and boat and business storage, which is unique. I definitely want to get into that in areas with strong market fundamentals and has a few strategic partner relationships. So with that, Wayne, welcome. Thank you.
Hey, Michael, glad to be on.
So one question I ask all of the investors that we interview here or come on the podcast is, how in the world did you get started in real estate investing?
Yeah, so I got introduced into real estate investing at an early age. Actually, it was in high school. I was good friends with someone whose dad was a developer in Austin. And so got the bug early. And when I went into the Marine Corps in 2003, bought my first single family rental outside 29 Palms base, and realized quickly that single family rentals was not going to be something I wanted to do long term. So we can go down that route if you want. But I joined CBRE in 2007. So getting out of the Marine Corps, I went right into working with a large commercial real estate company. 2019, so speed that from 2007 to 2019. I had just finished my MBA and got the entrepreneurial spirit and juices flowing again to start CREI Partners, a real estate investment company that we've grown to about 60 million assets under management. We've got we have 3 developments in the pipeline, and looking for multifamily opportunities as they come.
That's awesome. Congrats on all your success so far. That's
Thank you.
amazing.
And right now, if anyone's watching YouTube, whatever, like, we are in an RV benefiting from all that hard work, and commercial real estate provides. We're on a 9-month RV trip, and so I'm living proof that hard work, commercial real estate can really allow you to I don't want to say buy back your time, but also the location of where you are. I'm been grinding all morning on real estate and on a podcast with you right now, but I can do that anywhere just because of the blessings of commercial real estate.
Yeah, essentially you are allowing real estate to work for you. You're not working for real estate, so to speak. You're able to manage your time however you want, whether that's a 9-month RV trip or, maybe you're going to plug in a couple hours from 6 to 9 a.m. in the morning and then go for a swim. I mean, that's the beauty of real estate, is it can be passive just like that. Obviously, it takes a lot of active hours, I'll say, to get to the point where you're at. You didn't just get there overnight. But I mean, that's the power of real estate, and so that's why we're all doing this, right?
And you have build a team around you too, and we can
Right.
dive into that. If there's so many different directions, but I mean, just no matter where I'm at, there's so many active hours regardless of putting into our portfolio, and just the surrounding yourselves with a strong team, whether it's property management, asset management, investor relations, accountants, etc. It's much more than just one person.
Yeah, no, 100%. So you do multifamily investments, you do some development. Talk to me about the RV and boat storage. I don't think I've ever spoken to someone, at least on this podcast, where they're investing in what I would take as kind of wide open, maybe industrial-ish land, and maybe a building or two around it. But primarily, you're charging for boat or RV, like price per foot or yard, and that to me is like truly passive, because you're not fixing any broken toilets, you don't have laundry machines leaking from one floor down to another, you're not probably getting any crazy tenant calls. So I'd love to learn more about that.
Yeah, absolutely. And we definitely dig in. So about 80% of our portfolio is multifamily, and we like the cash flow, the tax depreciation, equity upside. I'm much more bullish on multifamily than I am RV boat storage. I just wanted to put that out there now. Like, our bread and butter and what we really, really focus on is multifamily. But 20% is more opportunistic. We have some office retail, a medical office. We do RV boat storage. And when I talk about that, I don't like the traditional self-storage. I think barriers to entry are quite low. It's easy to, build a small or a mini warehouse storage. Um, it's also uh, a different clientele, very transient, et cetera. So I'm more focused on the 20 by 50 storage. They're all 1,000 square feet. And to your point, we do price per square foot. At our facility, it's 70. We have two facilities. The one in Bryan's about 75 cents a square foot. One in Huntsville, Alabama is about 65 cents a square foot. So for 1,000 square feet, I mean that's $750, $650. So it takes out a lot of people who you know could afford it. So a lot of businesses, high end RVs, boats. It's still time consuming. Nothing in real estate is ever really passive unless you're truly a passive investor, which a lot of your due diligence and such is going to happen up front and during the paperwork signing, et cetera, for prior to you investing in a deal. So if you're passive, truly a passive at limited partner, yes, but from an active partner, and I'll just give you an example. One of my partners in Huntsville, Alabama, had to deal with, people, taking hot water and pouring it on the keypad at the entryway during a freeze event. And so, the keypad was frozen. So they had this brilliant idea of like, let's put hot water and try to defrost it. Well, that just caused bigger issues. I mean, but to your point, it is a lot easier. It is a lot easier than say multifamily, but it's still not a passive. It's concrete and steel. From an investor standpoint, that does impact depreciation, which is a big reason to we like real estate is those K1 losses for tax purposes. So it's something to consider. But at our one facility in Alabama, we've stayed 100% occupied with a waiting list. On our one in Bryan, Texas, we opened that July of 2024. And we're a little over a year in, and we're about 60% occupied. So when you compare that to like a traditional storage, it could take 3 years to get to the point where we're at now. So anyway, happy to obviously answer any more questions and all, but I wanted to just give an
Yeah.
overview.
No, it's interesting. Yeah, everyone, every different asset class has its pros and cons. My partner and I usually or primarily are investing in probably similar to you, multifamily and commercial buildings, whether that's triple net lease or just a simple 6 unit multifamily. But I love the commercial space for a number of reasons. But I'll turn that question to you. Do you primarily invest in larger scale commercial apartment buildings, or are you still dabbling in maybe the 2 to 4 range where you see opportunity fit? Maybe you're flipping it, or just for a simple cash out refinance. Are you strictly commercial, large, kind of institutional money? We'll say.
Yeah, and I'll say with that too, there's no right or wrong on strategy. I think if because like I said, I started out when I was 19 with a single family rental. And some people want to be more active. Some people want that they enjoy that ownership, that pride and ownership of owning single family, getting to know residents, et cetera. And they like that income. For me, I didn't see a real easy way to grow wealth through single family. Um, and so to answer your question, we're more focused on 100 to 150 units, and eventually we'll get to a point where we'll be doing 150 to 300 units. I mean, you think about all the time to go source properties, maybe it's through broker relationships or off market opportunities. You got to work through a title company. You still got to do earnest. You still got to do your inspections. You still have HVACs. You still have plumbing. You still have roofs. So if I can do 100 units and still have that go through that same process. Yes, we're talking about bigger debt, bigger equity, et cetera. But partnerships and syndications allow for that opportunity to do that. And especially it's helpful for like people who have no experience at all, but want to get into it. And they start off by investing passively. We have a lot of investors who have this idea like, oh, I want to do active investing, but real estate is not easy. It's a lot of grit, it's a lot of stress, it's a lot of ups and downs. And so if you have a day job or you're, you know, thinking I might enjoy it, like it's better to partner with somebody who like does this and has a team, at least in the beginning.
Yeah, and you can learn the ropes without if you go by. Listen, I'm a firm believer where you should definitely own property, and then you'll appreciate how hard property management is, and you'll appreciate how hard maybe a number of different things that go into real estate are. But for those, maybe high earners, W-2 employees, where they have a full family and they just don't have time to invest and buy their own property and manage it and do all that. Something like what you're offering, where hey, let me take all that stress out of it for you. I'll still give you a double digit return, which maybe you could do yourself, but maybe you couldn't because you don't have any experience. And you'll still get all the benefits from owning real estate. So actually, talk to me a little bit about how you're raising capital for these 100 to 150 unit complexes. Are you doing debt? Are you doing equity? And if you're doing maybe a combination of both, or if you're just doing equity, what kind of returns are you offering to your investors, and how is that structured?
Yeah, so a lot of investors that we have aren't looking to get out of their day job. I know that that's sometimes pushed out there, like, oh, all this passive income gets you out of your day job, but most people enjoy what they do, but they're looking to diversify off Wall Street. And I own stocks that I just do the S&P 500, um, and really just focus in on real estate because that's where my passion is. I don't have the time to go look at stocks and do a trade here or there based on I don't have the time for that, but I do have time for real estate, and that's where my passion is. So investors that come to us are looking to diversify. They're looking for those tax benefits, passive losses offset passive income. That's where depreciation comes into play. And they build this. They build a portfolio. So how we do it is we'll every think of every property as its own business. I always like to really break it down as simply as I can. So if we go out and buy a 150 unit property, that property has an LLC entity. Okay, so there's an entity, a buying entity, a single um, special purpose entity that was created just to buy that asset. And within that asset, you have what we call general partners, which is where the active investors sit. That is where I would sit as someone signing on the loan, someone who's sourcing the deal, putting earnest. There would be other partners with us as well. Maybe they're putting up some more earnest, or maybe they're helping with asset management, whatever it is. That's where the general partners sit. They're the ones who are going to source the deal, close the deal, and then actually be the jockey on the horse executing the deal during the life cycle. And then you have what's called limited partners. And the limited partners is they're limited to the investment they put in the deal. So say there was a lawsuit or the deal foreclosed on, et cetera. Those limited partners are only their risk is the amount they put in. So a lot of the work is up front, listening to your podcasts, doing investor education training, reading books. We've got a passive investor coaching program at passiveinvestorcoaching.com. It's free. It's free content, but it's over 5 hours of content of just accelerating that knowledge curve for passive investors. And then once they invest, that's when the returns start getting into. Now the returns are going to be presented up front. So there'll be a business plan, a webinar, and then in that webinar, it will go over the team. Because remember, we're buying a business. So think we're buying a business. So you want to know as an investor, who's the team going to be executing the deal? What is the business plan? How are we going to grow income? Ultimately, think of income as total net operating income, revenues minus expenses, net operating. So I can increase revenues or decrease expenses, or a mixture of both to maximize NOI, which maximizes the value. It's not like single family, Michael, where the house next to you sold for 200, so your house is probably about 200. It's all income generated to maximize value of the asset. And what we typically see is a 4 to 6% annual return. So cash on cash. So say you put in $1 million, or excuse me, $100,000 year, for the investment. Say $4,000 to $6,000 is distributed as cash flow for that year, and then say it's a 5 year hold, and then we exit, and you would get profits at exit. So what typically will happen in our experience is we'll see an 18 to 20% average annual return, and that includes cash flow and exit, without having doing any of the work, the headaches, dealing with tenants, toilets, termites, as you had mentioned earlier.
Yeah, no, that's pretty aggressive and solid numbers. Are your investors getting, so if your time horizon's 5 years, are your investors getting a lower return between years 1 and 4? And then when you annualize it over the 5 years, it gets to that, the 18-20%, or are they getting 18 to 20% in years 2, 3, and 4, um,
Yeah.
up until the point you sell?
No, great question. So that average 18-20% average annual returns is cash flow during the whole period and at equity sale. So it's the average of all that, right? It's the combination. So typically what you would see is years 1 through 4, you would see between a 4 to 6%, maybe upwards to 7, maybe even 8%. On my RV in Huntsville, Alabama, we've been doing 10%. So there's going to be one-offs that do double-digit returns annually, but I would say 4 to 6%. And then what happens is you get a K1 that for tax depreciation, you'll see some passive losses. That's not a negative thing. Those passive losses is just it's sort of think of it like a credit on your tax statement, offsetting income, which reduces the taxable
Yeah.
liability that you're responsible for.
So now, can I just play devil's advocate for a minute?
Sure.
So if one, I guess I totally understand the model, and I think it's great, and I think that is very active. I think for those, do you ever, I guess, do you ever think about, or maybe it's not for you, but for like a buy and hold investor, to you typically, to reach those 18 to 20% returns, you need to sell. You need to exit to pay everyone back, pay the bank back, to hit those returns for your investors. Do you ever see deals that are juicy enough where you could do a cash out refinance and you, as the GP, get to keep the deal equity, and also pay back your investors and meet those returns you promised them? So you like to, if your strategy was to be a buy and hold investor, because a lot of syndicators I talk to, it's really just a job, right? You're making a couple points up front on the acquisition fee, you're making a management fee, you're making the returns throughout the years, but eventually you have to sell. Do you ever find deals where you don't have to sell, and you paid back all your investors, and now you can just do a refinance, and now you just own it outright, or not outright, but own it with just your GP team?
Yeah, those are really good, all good points, and I love that we're going through this conversation. So first and foremost, we are a real estate investment company. Our priority is preserve capital and make you as wealthy as possible before
Right.
making our team. So yeah, it is a job because it is very outwardly focused on passive investors. The reason behind that is because I've got investors who are using that money obviously for their retirement, for their kids' education. This is personal, right? This is their investment of hard-earned money. So if I can 1.8 or 2 exit over a 5-year period, that's great. And we still get the ownership, because remember I mentioned the entity, the LLC. The limited partners own about 75% in our deals. Every deal is going to be a little different. This is where when you meet the syndicator, you look at their business plan. Typically 75% of that special uh, purpose entity, so that buying entity, 75% is owned by the limited partners, whereas 25% is owned by the general partners. So we are owners in the asset. We also invest at least 5% in the deal. So typically that's 4 to 600,000 or more into a deal collectively as the general partnership team. So we're also heavily invested in the deal. So um, as far as the returns, et cetera, I mean, when I was in single family and I only did that one and I was like, never again, I had that home vacant for like 4 months after a good long term tenant. And then there was no cash flow. We had to go in and do some renovations. All that profit that I sort of made got lost at, during the downtime. Whereas like if I have 100 units and my break even is 75%, like it has to be really bad. 25 of my units have to be vacant for me not to break even. So from a risk profile, I like that as well.
No, it makes sense.
And I feel like I
Where do
didn't
you
answer the
see?
whole question. So was there
No,
anything part of that I didn't answer? Because I do want to answer.
do you,
All those were good points. There were just multiple points.
do you ever end up keeping? Do you end up
Yes.
ever
Good
finding
question.
deals and keeping them after, instead of selling it? Do you ever refinance it, pay back your investors, and keep
Yeah.
it? Keep the equity for yourself.
So my number one job, as you put it, is to make my investor as much money as possible. So typically that happens during a capital event. So to your point, a sell. But an exit or sell typically is 5 years because the debt balloons in 5 years. So in commercial real estate, in multifamily, it's a 30-year amortized loan. Maybe you have 2 years of interest only, maybe upwards of 5 years interest only, but that loan expires in 5 years. Sometimes it's a 7-year loan, sometimes it's a 10-year loan. And so what we do is, yes, we will look to make a capital event or exit year 5. Part of that too, Michael, is if you think about the capital on 100 plus units, I may have to put in through the business plan $1 million for unit renovations, exterior, etc. Well, year 5, our capital for that property may be depleted. And so instead of putting a lot more into renovations or a new roof replacement or a pool renovation, whatever it may be, it's time to sell. So there's two reasons. One, again, the debt expires, but two, new capital has to be put in. So even if it's a great deal and you're still getting cash, right? That cash eventually needs to turn into continued renovations to maintain the property. Now we do have in our private placement memorandum the ability. So say if 15% IR is the minimum IR that gets us excited about a deal. But I'll put in there like if we paid you, Mr. Investor, 22% IR, then we can buy you out and you can reinvest, so you can recapitalize, or I can recapitalize the stack. So I need new debt, but it allows me the opportunity to keep existing investors in the deal so they keep their capital in, or we can bring in new. I would say 5 years is a long time. And so you start to get a little antsy, and 100 units starts becoming like a lot of work when I could buy 250, 300 units, and the wealth and the opportunity for our investors gets greater with the larger number of units. You're thinking 10 to $20 million assets off one property. Think about the returns of that and just the scalability moving forward, which is why I would exit to buy bigger
Right.
and more profitable
Yeah,
businesses, in this essence, multifamily.
makes sense. Yeah, I mean your opportunity set just gets bigger, and now you have the potential capital to go after the big ones. So no, it makes complete sense. Um, One question I always like to ask is, how do you spend your day? I know you're traveling in an RV,
Mm,
but maybe when you get
yeah.
back home, what does your day to day look like from the
Man, my
time you
day to
wake up
day,
from the
it's always the same. So I'll tell you, I'll break it down. So Buy Back Your Time, if you haven't read that book, definitely
Yep.
an incredible book. But we follow exactly that. So Mondays and Wednesdays, and I've been doing this for a while. Um, and I'm also part of strategic coaching. So for those entrepreneurs, people think about business controlling. So if you're a W-2 employee, which I was for 16 years, and if I didn't have this like desire to be an entrepreneur, like I would still be working for CBRE. It was a great company. They took care of my family. I took care of those clients. There's nothing wrong with W-2 employment. Like, so I just want to put that out there. Sometimes we're like, oh, join real estate, so you got a W-2. W-2, feeds families, all good. But if you have the ability to control your schedule, what I have implemented is focus days, buffer days, and free days. So I control my days in the sense of Mondays and Wednesdays are focus days. I'm only doing things that are going to create future revenue or focus on existing revenue. So how many times have you've gone a whole week as a business owner and you did nothing to generate revenue or growth? You focused on putting out fires, right?
Right.
So Mondays and Wednesdays, I don't check emails. I'm doing this podcast with you. It's Monday. This is an opportunity for future revenue growth and generating investor leads. That's what I'm focusing on. On Tuesdays and Thursdays, those are my buffer days. Those are the days I meet with teams. I do a lot of calls. I schedule, if I have to meet with a property management company, et cetera, Tuesday, Thursdays. And then every other Friday are free days. So for me, I take every other Friday off just to focus. I'm on a 9-month journey with my family, but every day in the mornings, I'm either doing a focus day or a buffer day or a free day, right? So I live that every single day. The afternoons, we're out exploring as a family. and then in the evenings I plug back in once the kids are relaxing, um, and the wife's tired of me, so I get my alone time. So yeah, that's pretty much how I do it. And now those days are longer, like when I'm back home, right? So my focus days is a full 8 hour, um, versus the 4 to 5 that I spend in the mornings, waking up early and doing that before noon.
Yeah, it's amazing. So I'd say, Mondays and Wednesdays you are working on the business versus Tuesdays and Thursdays you're working in the business. And I think a
Yeah.
lot of entrepreneurs, myself included, we tend to be so focused and you get busy working in the business, doing this, doing that, putting out fires to your point, versus like doing these podcasts, which could actually grow your net worth a lot more than just replying to emails. So
Yeah.
might have to take a page out of your book on that and just
Yeah,
focus like Tuesday.
buy back your
Yeah.
time, like my email
I,
system, and then the strategic coaching. If anyone out there is listening, or any entrepreneur, whether they're, and I find doctors, attorneys, I mean, there are entrepreneurs in their own set because a lot of practice, but I, I've been year one strategic coaching. It's constant learning, constant like joining mentorship groups, joining masterminds, etc. And I would say strategic coaching has redefined the way I look at my days. I mean, we just started, it's year one, but I would say that's a pretty big adjustment.
yeah, no, it's really good. Well, Wayne, thank you so much for your time. I usually, like I said, like to try to keep these 25 to 30 minutes. You've shed a lot of insight and knowledge to a lot of the listeners. So thank you. For anyone who likes this podcast, be sure to like and subscribe. And Wayne, we will link all the show notes where people can learn more about you after this episode is edited and produced. So thank you again. Really appreciate your time. And we'll talk again soon.
Thanks, Michael. Appreciate you.
Thank you for watching Sky's the Limit. We're always releasing new real estate content, so if there's something you want to hear, be sure to leave a comment. And don't forget to subscribe to our channel.